3,
Still think Talking Heads.
2, 1.
I still think Talking Heads.
And bam.
Yeah.
Talking Heads when we
Talking
play
Heads, Wall Street.
that? Oh, yeah.
You know?
I don't, man, the hard part
I don't
is.
want to get sued for
yeah, we don't want to get sued for that.
Yeah.
Yeah, so for those of you that don't know, there's a little ditty in the beginning of Wall Street, the movie, like the sounds, and it was from the Talking Heads.
It's the Talking Heads song. Yeah.
We would love to play that because we're kind of like, Wall Street. But if we did, and it turns out like, I don't know if anybody remembers the Vanilla Ice song, Ice Ice Baby.
Yeah.
There's a little dun 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 that he stole from.
I know the story. I don't remember. Yeah.
Anyway. Lots of money involved,
yeah.
And we ain't got that money, so we don't want to get sued. So you know what you get? You get the because that was already
came with the box. Yeah.
That's what came with the box.
It's not horrible. It's pretty good.
No, it's good. All right, man.
Oh boy.
No more music. What do you got?
Yeah, we got a lot of stuff. This week. All right. Weekly update show, 28 March 2021. So for the last 2 weeks, we've been talking about Edwin Lefebvre.
Now listen, man. There's quite a few people that got onto the comments and explained to you how to pronounce it.
Yeah, you're right. There was a lot of people explaining a lot of things to me this week. So
they explained it, but I don't remember what it was.
Yeah. So anyway, we're gonna do a not a competitor necessarily, but a different twist on it. As much as that book is classic technical analysis. The Intelligent Investor, the definitive book on value investing by Benjamin Graham. So Benjamin Graham, I don't have the dates here, but he, I think, was born like 1845, died in 1976. But he was Warren Buffett's mentor. And this quote here, by far the best book on investing ever written. By far the best book on investing ever written. That's pretty all-encompassing.
And you're going to make me have to go on Amazon right after this.
Well, so for Warren Buffett to say that, right, it's impressive, right? Yeah. Okay. This book is like 2.5 inches thick, and it does not read like the story that Edwin told us in that.
Right. It wasn't a fun read.
No. Yeah. Now, it will make you much smarter, but you'll have a very rough time getting through it.
Yeah.
I haven't made it to the end. I'm just saying. So, from the back cover, the greatest investment advisor of the 20th century, Benjamin Graham taught and inspired people worldwide. Graham's philosophy of value investing, which shields investors from substantial error and teaches them to develop long-term strategies, has made the Intelligent Investor the stock market Bible ever since its original publication in 1949. And I don't disagree. It's not technical analysis. It's fundamental analysis.
But isn't it crazy? Like I think about this every once in a while with other topics, right? So, you know, Jerry, that I've been a closet academic for a long time. Like I like to go to college even when they're not going to give me a degree. Like I do stupid shit like that.
It's good to want to be able to learn stuff.
Yeah, I like to learn stuff, right? So I like to be like a sponge. And sometimes I think about this and I'm like, no one has written anything since then that like is as good as that? Like, did we stop thinking? Or is it just that they got it right and then there's like, you're not really going to do any better than that? Like, that's the kind of things that I think about is like, okay, either they nailed it. Like, why redo it? Right. Nothing's changed? Like, nothing's got better? I don't know.
It's not that nothing's got better. Things are much different. I mean, there are a lot of books, obviously, that have been written about all kinds of different perspectives of the stock market and technical analysis, fundamental analysis. All of them refer back to those books.
To there, yeah. I mean, that's kind of the way, academia is, right? That's the starting point, so everybody kind of goes from there. But I think somebody should have the balls or the ovaries to sit down and just kind of start from scratch.
Have at it, brother.
Well, no, I'm challenging. I'm challenging you.
Oh, I got a job to do here, man.
I'm challenging you.
Yeah, I don't need a challenge like that. No, I got stuff to do.
There's got to be somebody out there that wants to rewrite it.
I want to meet the guy who wants to write the schematic, the engineering schematic of how to create the crystal ball. That's what I want.
Yeah. I mean, you're definitely more of the engineer, kind of in the,
Yeah. Actually, that's interesting because you're
It's
right.
very interesting since you're a
I'm a
political science major.
Yeah, that's where I was going with that.
But the Navy always wanted you to be an engineer.
The Navy just didn't want me. Period. I should have went to Stanford. Big mistake.
I think this podcast has taken a whole new.
Yeah, we've gone in a different direction. But it's not what we talked about in the beginning of the show.
No, it's not.
It's not what we prepped at all.
It never goes that way. But I think it's important that the people that watch this show know where we're coming from.
Yeah.
Right?
Yeah.
I always talk to Jerry about that. I'm like, listen, man, if people knew how much thought you put into this, right? You don't just wake up in the morning and be like, oh, I'm going to go to the Tsp Fun today.
Yeah.
No, it's not how it works. Like you have to be no offense, bro, but you have to be a different kind of person to care enough to really study this stuff, right? And so that kind of analytical drive. I'll give you an example. I know people. Well, there's a movie about it. Like I know people that were involved in this movie. I can't remember the movie right now, but it's about the lady that basically would not quit till she found Bin Laden. Right? They made that movie, right? And so I know some of the people involved in that, on the agency side, and it's that obsession, that desire to know, whatever. Like there's an analytical, there's a thing. You can't make that. It just happens, and that's kind of how you are. You're gonna. I always joke with people all the time. I'm like, Jerry,
this is coming.
I'm like, Jerry, you're gonna do this whether we do a podcast or not. Right. You're gonna do this whether we do this as a business or not. You're gonna wake up in the morning.
I do when at 6 o'clock, which I usually wake up at 5.
Yeah. What time does the market open?
Well, futures start at 6. So the first thing.
No. What time's the market open, Jerry?
9:30.
Right. By 6. Jerry's already looking.
Yeah.
And so when people are freaking out because we made the decision at 10:30 or 11, like, dude, do you know, like, there's a whole day left and we only just got a little bit of information, and it takes a lot of processing power, a lot of computing power of brain work to go, what do I think is going to happen the rest of the day? Much less the next day. Much less the next day. Yeah. We're talking about the rest of the day.
Were you reading my notes? Because we're going to get to some of that.
No, but I'm on a little bit of a.
We talked about that a couple of days ago. Yeah.
Yeah. All right, I'll let you go. See, we were just joking before the podcast came on that if I just shut up, this whole podcast would be 15 or 20 minutes.
It's going to be 3 hours for I can tell.
It's one of those days.
Yeah, it is one of those days.
All right, give us the score.
Let's go to the next one. We're off of Warren Buffett's favorite guy, Benjamin Graham. It's a wicked boring book, but if you're snowed in or something and you want to get really smart about value investing, it's a great one. Okay. Kind of a strange market this week. It was pretty mixed. By the end of the week, C Fund was up 1.57%. S Fund was down again 2.25%. I Fund more or less flat, up a little less than 0.25%. And the F Fund was up 0.35%. We're going to get to the F Fund at the end. We're going to do all these stock TSP stock charts at the end. These are the 4 main topics that we're going to talk about on the show. It's kind of a hodgepodge of things, but I think we can get through it all, and it's all very relative to what's gone on this week and last week, and making sure that we're all sort of on the same page. Before we get to these 4 things, we put out an alert on Tuesday, and we got some really interesting questions on Facebook about all that. We say this in every show, and we write it at the bottom of every alert, right? This is an education site, okay? The alerts are letting you know what I'm doing with my TSP account based on my analysis of the market at the time, right? And my personal risk tolerance and my circumstances. Right? The idea is not to follow it blindly, right? We've talked about that all the time. The alert is to use the idea is to use the alert to validate your own decisions, right? We don't manage your money. And since we don't manage your money, and we don't know if and when you got the alert that day, we can't guarantee that you can make the trade by noon to get that day's closing price. Right? There's just no way for us to do it. And if you don't understand the mechanics of an alert, go to the the smart reading tab,
We have
and hit the post that says the mechanics of an alert.
That says, yeah, exactly.
So and you know, I know a lot of people, because I've gotten some good feedback on Facebook, are anticipating alerts before they come. I'll see, you know, hey, should I be checking my email today? You know, there are people that by 10 in the morning are doing the same thing we're doing. They're anticipating, because they've done the homework. They know that something's coming. You can smell it.
Because either we've educated them or they're already educated.
Right. One way or the other, but they can see it coming. So if you do your homework, you should be anticipating these alerts before they come out and have a plan, right? At least notionally. Okay. So we had a question about the F fund this week. Okay. Why wasn't the F fund part of the alert? Because last week and the week before, I think, we talked about how the F fund had a great Elliott Wave 5-way pattern down. Remember that?
Mm-hmm.
Okay. So by Tuesday of this week, when the alert came out, the F fund had turned the corner, which is what we sort of expected. And we talked about it last week on the show. But I didn't have another move to move into the F fund, right? So as we said, the alert is about what I'm doing with my TSP in my circumstances. I didn't put out anything about the F fund because it wasn't an option for me.
Right.
Right? That's why.
Yeah.
Right? And I can't say, well, I can't do alerts. Well, alerts are what about my account, not other people's accounts.
You can't do alerts for every single person.
Everybody's circumstances are different. I can't do an alert for every circumstance.
Right. And there should be no expectation, right? If people put this in perspective, right? So we know people like, you know, Kramer on CNBC, and, you know, there's a lot of people in the investment world that kind of have their version of what we do, which is, hey, this is what I'm doing.
Yep.
Watch what I'm doing. I'm not moving your money.
Right.
Right. They're not. It's not a hedge fund.
No.
It's not a mutual fund. I'm not moving your money. What I'm telling you is I'm giving you a little insight into my analysis.
Right.
I'm moving my money here. If you have faith in that decision, and your risk tolerance is the same, and your circumstances are XYZ, great. It's just like doing a math problem in math class, and the teacher eventually gives you the answer, like the whole thing, and you're like, that's the answer, but I did a little different. I came out with the same, So you're doing the math problem. You're like, hey, listen, this is what I came up with. This is where I'm going. If your circumstances are different, they're different.
Right, they're different.
There's no way that we can make a decision for thousands of people before noon.
Right.
Just can't happen.
It doesn't work.
If that's the expectations, then don't do this, because our expectation is, I'm sorry, I'm on another.
No, go ahead. Yeah, no, do it.
I'm on another rant. Our expectation is that we do everything in our power. Okay, our product, I want to pause for effect. Our product, right, is education.
Absolutely.
We found out through trial and error of being in the government for over 30 years that we should have done things differently.
Yes.
That's what we found out. We failed time and time again. Right?
Yeah.
We found out that that was not the way to do it. The way to do it from day one was to take these technical indicators and do our best to follow the trend.
Yep.
And be in when the stock market is going up.
Yep.
And out when it's going down. Yep. And anything more than that is crystal ball.
Yep.
Anything more than that. We don't know how far up. We don't know how far down. All we know is at a certain point, we draw a line in the sand that says the probability is historically and all the technical that's going to go up or down.
Yep.
And we're in or out. Yep. And that's it. And all the other stuff doesn't matter. Right. And if you ask people, if you get a chance, if you had enough money to ask Warren Buffett the answer to that question, I guarantee he'd say the same thing.
Yeah.
Because he's quoted as saying the same thing.
Yeah. Yeah.
Yeah. The index funds. That's, to Blackwater. Yeah. To BlackRock. Yeah. To BlackRock's credit, that's what we chose, to BlackRock and to the government, to Congress.
TSP, yeah.
We have these indexes. Why? They're not as volatile.
Yep.
they're more steady, so we can follow the trends. If we only had like 11 sectors of the S&P 500, this shit would be crazy.
Yeah.
Totally different.
It would be completely different. And of course, if we could trade every day and all that, it would be completely different. But it's not. It is what it is. All right. Let me just
get back on track.
Get back on track. All right. So the other big question we had for the day was not something we hadn't, well, something we see all the time. If I didn't get the alert until after noon and I couldn't get today's closing price, can you do something to tell us what to do for tomorrow? And if you read the alert, I went into like extreme detail to show literally the minute that I decided to reallocate on Tuesday. It was like 10:45 in the morning, and I showed the chart and had the timeline on the chart and the whole thing, and exactly why. And each tick on the chart, I think, was like 10 minutes. I mean, it was to the minute of why I did it. So the question of, can't you just tell me if I miss the alert, what should I do tomorrow? I'm like, the question blows my mind because I couldn't tell you for sure what you should do at 3:00 on the same day. But I have to make the decision before noon, right? But I can't tell you for sure what you should have done that day. I'm basing it on literally what's happened going forward, and now what I'm seeing at 10:45 in the morning. Because it ticked a little bit lower than the prior low, that's it. I'm out.
Because you had your lines in the sand.
Yes.
And if you remember, you get a little bit more insight to where those lines in the sand are.
Yeah.
We made them. And we're like, hey, if it does this, I'm out. If it does this, I'm in. And it really becomes that simple. And if people follow us long enough and they take time to educate themselves, they can spend, I'll say 30 minutes a day, right? Probably
that's a lot.
Probably could be a lot less.
Yeah.
I'm just going to say 30 minutes a day, tracking certain things and to say to themselves, okay, here's my decision point.
Yeah. It's like riding a bike, literally.
Yeah.
You look up at the TV, you know the numbers in your head, you look up and you go, okay,
it takes some time to learn it on the front end.
Yeah.
But once you get your lines in the sand, once you get your lanes, you're good.
Yeah.
Honestly, you don't even need us at that point.
Yeah.
What you need us for is just validation.
Yep. I get those validation type questions on Facebook all the time.
Yeah, it's like, okay, well, I want to do this. And I mean, it's what I do, right? I think to myself, okay, I know Jerry's doing this. I'm a little riskier right now, like in my IRA. Here's the funny thing. Again, here's a little tangent, right? It blows my mind when people tell me I'm retiring at 55 or 60, right? I got 30 years in the government. I'm retiring. If you're a military member, that number's a lot lower. You're younger, right? So you're retiring and you're like, oh, I want to go into these, I want to but what? No, you've got 30 more years or 20 more years of stuff to do. Why? You have to stay in the game.
Yes, absolutely.
Would you just quit and just say, I'm not going to make any more money? No, you're not. You're going to stay in the game. Now, maybe you'll be a little more risk averse.
Yep.
I get that part, right? I'm not, because I'm not going to impact, this segment. But this segment that I have in an IRA, that's game on.
Yeah.
But I've made that decision. That's my risk tolerance. That's my personal situation where I'm going to go, I might go a little bit harder into but it's not a guess. It's not a crystal ball.
Right.
It's because I'm willing to risk just a little bit more. But if I'm wrong, I pay for it.
Yeah.
Right. But the indicators are there. The difference is probability and possibility.
Yeah.
Right. Jerry is 99 times out of 90 going to be a risk averse.
Yeah.
If you guys haven't figured that out yet, like, you're not paying attention. Like, he's gonna err on the side of no.
Yeah.
Right. And that saves you money.
Yeah, I'm going to err on the side of no. And we came into this current reallocation at 50C, 50S.
Right.
And I'm retiring next month.
Yep.
So put all those things together. So on the one hand, you're right. I am risk averse.
But you're still in the game.
I am totally in the game.
Yeah, it's not going to change.
No, it doesn't, because So
most people would say like, "Oh, I'm all G. I'm retiring next month.
Right,
I'm all
I'm
G.
all G.
I'm L income."
Yeah, I know. I know.
No.
I owe, if Bill is watching the show, I owe him a phone call about exactly what we're doing here, because he said, I spent my whole career in the Navy in the L fund, and I don't understand why that's not a good idea. And I haven't had the bandwidth this week to get back with him about it.
I mean, it's not the worst idea.
No. It's his,
the worst thing that could happen is you spent the entire time in the G fund.
Yeah.
And that's just said, well, you put it in a savings account.
Right.
And you didn't know any better, and that's okay. But here's the takeaway. Let's say, and we've had this, we've seen this, right? We've seen people that have spent 20 years in the G fund, and they finally came across what we're doing. Mm-hmm. And here's what I tell them. Like, if I get a chance to, I'm like, it's okay.
Yeah.
I didn't do anything much different. Like, I didn't come across Jerry until late in my retirement, and the way that Jerry kind of, attacks this. And I thought, you know what? I still got a good 20 years that I can get in this game, and I can kind of fix it. Now, it'd be great if I'd have done it the past 20 years, but no, I'm attacking the next 20 years. And that's why I'm a little more aggressive, right? I'm a little more risky, because I'm like, I want to get the most I can out of this. Because for me, it's not about I can pay my bills. For me, it's about, do I have, wealth for the next generation kind of thing. Right. It's a generational thing. And so everybody's got their different takes on it.
Right. Most people have these kinds of conversations, and I just, in my mind, I always want to keep circling back to, you can have all the goals and circumstances that you have. The only risk that matters is the market risk.
The market doesn't care what your goals are.
The market doesn't care about you and your rules and your circumstances and your goals.
It's going to go up and down regardless of what we're looking to do.
Right. So if you can get into the market when it's on ideally the two leg of the Elliott pattern, you've got a long way to go, and it's just going to keep going up. Right? If you can identify where you are in the pattern, you can save yourself big drops, and you can make sure you're in as early as possible at the bottom. And we're going to get into all that. Actually, it's the second bullet, right? Last week we did Elliott Wave 101, right? This is 201.
Yeah, if you guys missed that, go back and watch that part of the episode. Understand the Elliott Waves, because what Jerry just said is worth $1 million. And if you don't understand that, if it irritates you to pay $20 or $200 to get this, we're giving this part out for free, right? If you understand just the Elliott Wave pattern, and you look at it and you see, hey, I kind of think we're at a 2. Yeah. And you ride that thing.
Oh, yeah, you're good. You're going to make a lot of money.
Come on.
Yeah. No, it's good.
Let's
keep going. Seriously, it's going to be a 3-hour show, bro, at this point. I know we all have stuff to do. All right. So let me just continue. Here we go with my thing. All right. So obviously, I don't have a crystal ball. I don't know what's going to happen tomorrow. I totally appreciate the frustration, but it is what it is. All right. So lastly, the Facebook group. We've got a ton of feedback mostly from subscribers to the site that want to see a closed group for members only. We've been pushing back on we've been talking about it, but we've been pushing back on the idea because it's an extremely manual process to ensure that only paid subscribers are in there. And what happens if you cancel your membership? How do we make sure you're out of the group and all that? At this point, I think the need for a closed group is outweighing the added work on my part. So I am almost actually done standing up that group. You'll see it by the end of the weekend. Yeah, go ahead.
Can I throw my
throw your 2 cents on it?
As the tech guy, just to be transparent to you guys, I told Jerry, I'm 100% against this.
Yeah.
Right?
I didn't want to say that. I wasn't going to throw you under the bus
I'm
like that.
100% against this. And I'll tell you guys why. I wish Facebook gave us a way to connect, who's a member and who's not a member. Because that's the key for this thing is, if you're not a member, you shouldn't be able to get that information, right? So that's kind of the deal. And Facebook doesn't give us a way to connect our member management to that. But I will say that so I think that it's not sustainable. right? So as we get more and more and more members, this manual process is going to suck.
Yep.
And I want you guys to hear that it's going to suck because it literally means we have to vet every single person that comes in. Yeah. And then once you cancel your membership, if you do, and that's okay because people do, we have to take you out. And it's manual. It's not automatic. So I'm willing to be proven wrong because I think the value of it is important enough, right? But I think it's going to be difficult to be sustainable. And I'll tell you guys what. So here's the deal. So the reason why, and here's the funny thing is, we get people that ask us all the time, like, why do you charge $20 a month? And I'm like, I don't even know how to have the conversation. Yeah. Go find somebody that will advise you on anything financial for $20 a month. But if you guys think that's too much money, then I'm sorry.
I mean, I wouldn't teach you how to do a handstand for $20 a month.
We did. No.
Right.
But okay. Let's just say, I mean, everybody's circumstance is different. I got it. Okay. It is what it is. The point is that as we add more manual things like that, that means eventually we got to hire somebody to do that. Yep. Because we can't. Are we going to ask Jerry to do analysis of the market or vetting Facebook people? Right. So I just kind of want to put that out there for people because
so just to make the distinction, I'm going to be in this Facebook group much more than I was in the public group.
Absolutely.
Okay? But that's much different than
because
vetting.
You're a paying member and you deserve that attention.
Yes, definitely.
And anybody that's not a paying member and gets offended by that, I'm sorry.
Yeah, too bad.
It's
going to be a really good
because we
I'm
put this
excited
out
about the
for
group.
free.
Right.
We will never stop doing this.
Right.
We will keep doing analysis of the market and we will put this show out for free. Yep. Everything else is for pennies a day.
Yeah.
Right?
Yeah.
And so the last point I'll make though, right, is that those that are members, you have to manage expectations.
Yep.
Meaning that we literally can't sit there on Facebook all day long.
Right. That's true. Right.
You just can't physically, right? Even though this is going to be full-time gig, this is not possible, right? There's other things that we're doing.
No, we have a lot of work to do.
Yeah.
And then very little, well, it's all going to ultimately end up on Facebook, but the prep for it is going to take
So the idea is that you don't get Jerry's attention. Yeah. What you get is the opportunity to talk about things
amongst all of us, right? I don't want to say amongst yourselves, but amongst all of us, because I'm going to be in there too.
That are fine. But it's we won't put the same restrictions that we do on the open group,
right?
Because we have to, because we're like, hey, we can't talk about that because that's what we're talking about,
right? Well, that is really the bottom line about why to split into two different groups. I mean, the public group now it gives us an opportunity to be like much more general about how to grow my TSP. So that was one of the things that really kind of struck me in one of these feed strings was the title of your page is misleading. Mm-hmm. And I agree. It's true. It doesn't say grow my TSP using technical analysis only and you can't talk about anything else, right? I mean, and neither will the members only group be a thing where you can only talk about technical analysis. But in the members only group, the expectation is you understand what's going on here and you want to be a part of it, right?
Yeah.
So
and we like the discussions about it. It's just that once we go down the road of like what you put on an alert and what you did this, it's like, okay, we can't talk about that.
Yeah. In the public group, you can't.
And now we'll be able to. But I just want to manage expectations that, as this goes forward, if you become a member at noon on Saturday, okay, and you don't get access to the closed group until Monday, you're going to have to be okay with that. Yeah. Because it's literally a manual process.
Every single person that's in the group.
Jerry is not going to sit there at 10 p.m. on a Saturday and vet that. Yeah. That's just not going to happen. I mean, you're looking at all the employees.
Yeah. You're all the employees. Yeah. I mean, we're going to get an email out this weekend, and it's going to explain this process and I've already built the questions for what you're going to have to answer to validate you into the group and the whole thing. So that's probably enough of all that.
Is there a question that says, I'm not going to say, is there a question that says, I'm not an asshole?
I was much more politically astute than that. I was a political science major after all. All right. Well, I'm on number 7. Conan, do you want to talk about the stuff that you added to the site this week?
Oh, yeah.
Right, absolutely. Good. Not that I want to give you another thing to talk about, but
I know. Yeah, I was pretty excited about this. We've been working really hard on. So one of the things that Jerry and I decided early on is that we wanted to be. So if you take the perspective that we are an educational, institution, right? That's what we're trying to do, is educate people on how to manage their retirement so that, you make the best of it, you minimize your risk, and you maximize your gains. So if you do that, you got to be transparent in what you do as much as possible, right? That's always a good thing. We try to err on the side of transparency. So two of the things that we know we haven't been able to be as transparent on, just because of circumstances, was historical allocations and historical performance.
Yep.
Those are two things, right? And so most of it,
and they're separate. They're different.
Very, very separate things, very different things, but two things that if I don't know exactly what you're doing or what we're doing, I need to see those to kind of get my head around it, right? And we knew that. People tell us all the time.
All the time.
But we had to, some of it's just technology, some of it's just getting it done, the bandwidth, whatever. So we've been able to get part of this done by adding the allocations page, right? So what we've done now is we've gone back and, except for the last, I think it's 30 or 60 days, I can't remember now what we decided, but basically, the current allocations, that's still members only.
Yep.
But going backwards, there's not a lot of value in what we did 2 moves ago.
No, in terms of making allocation decisions.
Going forward, right? So that's not hurting any current paying member.
Right.
But there's value in understanding, okay, what is it you guys do, right? So now we've put on the site the allocation moves, and I think most importantly, because it's not just the allocation move.
It's why we did the allocation.
It's why you did it. Yeah. Because let's just say Jerry puts out an alert that says 50C, 50S, right? And he writes up an analysis that tells me why he did that, which is exactly what he does. And then I read that and go, okay, I'm educated enough. I'm learning. I see what you're doing. You know what? I'm 75-25.
Sure.
Right? I actually do that.
Yeah, of course.
Right?
A lot of people do.
In my IRA account. Now I know that I'm on a different sync now. I know that I'm doing a different game, and I have to factor in my rules. I can't come back and bitch at Jerry because his next move was XYZ, and that doesn't match up with what I did, right? I know that. So, but it gives me what I need and what you guys need listening to this. What you guys, whether you're a customer or not, what you need is information, not data, right? We pull data and we make it into information.
Right.
You need good info, not hype, not Bloomberg, not CNBC. Right. This is what the freaking market is doing. Yep. Make your decision.
Yep. That is ultimately what we're trying to do.
100%. Yep. Like, it is that simple. If you're watching this, make your decision based on your personal circumstance. Yeah. Validate that decision on what we did, right?
Knowing that we did it based on our personal circumstances.
Exactly. Or our risk tolerance or all those things, right? We're gonna have to say that ad nauseum.
Everybody wants, and including me, all of us, everybody wants like a straightforward answer.
Just tell me what to do.
Just tell me what to do. It's not that, A, we can't, and B, it's not that simple.
Okay, well, I will throw a monkey wrench into that idea.
Please.
As I always do. The first 10 years that I followed you, right? I'm in the gov. We're saving the world. We're killing bad guys. Whatever it is we're doing. Jerry's chuckling because we all know that we're not really doing that, but we think we are. But whatever. So we're out doing great things, and I felt like I didn't have the time.
Sure.
Right. So when Jerry's alerts came out, I moved my money and moved on.
Right.
I did exactly whatever, but that's not to say that was the best decision. It was my decision at that point because I just didn't have the bandwidth.
Sure, you had other things going on.
I wanted this guy to have the bandwidth to figure it out, and I'll just make the changes and move on, right? So there's nothing wrong with that. It's not to say that you can't do that, and we have lots of members, especially some of the early on ones. Yep. They don't even watch this show.
Right.
They don't read the analysis. Right. They literally don't read the newsletter. They don't do anything. Alert comes out, says to go here, go here. They make the change. They go back to work.
Yep.
We know that we have those people, and that's okay.
That's
as long as you know that you're making your decision based on our personal risk tolerance and circumstances.
Right.
As long as you're cool with that, that's fine. So all the people listening to this, we're trying to give you kind of an insight as to how we do this thing. And so I just throw that in there that, you know, probably at least 7 or 8 years, I just pushed a button, changed it, and moved on. Now, that's very different now that I have more time to focus on it. Yeah. And what I hope is that I'll be able to match my investment portfolio to more to what I want versus what you're doing.
Sure. You know, the longer we do this together, our individual portfolios will definitely diverge, and they might come back together, and you know, but you know, your life circumstances are much different from mine,
and everybody's is.
Yeah,
everybody's is.
So
so take that for what it's worth. And next slide.
So the performance page is coming, but the allocation page is up.
Allocation page is up, so you get to see
past allocations and past alerts.
Past alerts. I will say that some of the alert analysis, right? You have to match up date for date. If you see, so we basically put all the way back to, I forgot how far back we went. It was 24 months, I think. And most of that was just because of brevity. Like there's only so far you can go back that it makes any sense. But the analysis posts go all the way back to when we started the site. But some of those posts don't have the charts. We're working to get those charts back in. It was just when we moved over from the old site to the new site.
That was the thing. So if you guys remember,
we didn't realize that those pictures didn't come over.
Right.
So we're slowly adding those back in. If you're looking at something from 2018, you know, give us a break. We'll get that picture in there. But anything from like 2020,
well, from October forward, because actually anything before October is not,
because when we moved the site. But we're fixing it. The other piece is the performance. So this is actually, I think, I wouldn't say it's more important. I think it's just as important as the allocations give you a glimpse of or an idea of how we're making decisions.
Yep.
The performance is how well those decisions played out.
Yes, definitely. Yeah.
And we understand that is very important. But what we don't want to do is give you half of the story. So it would be very easy. And I actually got caught up in this early on. I just wanted to throw our PIP out there.
Yeah.
Because our PIP is pretty damn good.
Yep.
But it doesn't mean anything.
No.
And we know this. We know that our PIP, it's called a personal investment performance for a reason. If you guys go to the tsp.gov website and just educate yourself on what the PIP is. There's no apples and apples. My PIP and your PIP have nothing to do with each other.
I mean, it's an apple and a pear. It's close.
It's still a fruit.
I mean, it's not. It's pretty close.
Yeah, but it's not close enough.
It's not close enough. The
point is that what we're going to use is actually, if you guys go on the tsp.gov website right now and look under their performance, you won't see any mention of PIP.
Nope.
What you'll see is rate of return.
Right. Which amazes me because I don't understand why the PIP became the thing that went viral.
Because they don't send you when they send us that thing each month.
Yeah,
it doesn't say rate of return.
That is you're absolutely right. That is why that happens, and it says PIP.
And we think that's the thing.
Yeah,
and what they should.
But everywhere else on the site, they talk about rate of return.
That's because they know that PIP doesn't mean anything.
Then why would they send out PIP, right? It's not, it's rhetorical, but why send out PIP?
Can we blame BlackRock? I don't know.
I would blame, what's his name, Larry Fink, for a whole bunch of things.
So here's what we're going to do. We're going to give you monthly and yearly rate of return, right? So we're working on, it's not that we're working on that. We had to hire a company that can basically recreate what they do on the tsp.gov site. We're literally using the same software they use because we want you guys to be able to come to our site and get apples to apples, 100%. Rate of return for G, not G.
It's a chart. It's just like the
CSNI and the indexes versus Grow, basically. The other piece of that is the not just the rate of return, because rate of return is not the entire answer.
It's not.
The second part of that answer is risk-adjusted rate of return. And let me, and this is what you guys will see once we get it finished. If you had a 12% return and another person had a 10% return, but their risk-adjusted return, meaning they took into account the risk, was a lot different than yours.
Right.
That means I'd much rather have 10% and sleep well at night than 12% and I can't sleep because I don't know what.
Right. So it's almost like what happened this year, right? Like if you, at the beginning of the year, we had a 34% drop in the C fund, right? If like right now, your 10% up, let's say. So let's say your rate of return right now is you're up 10%. Your PIP is 10%. If you had gotten out on our alert back in February, you wouldn't have taken that 34% loss. So if your PIP right now is 10%, and the C fund, let's say, is also 10%, right? This is not accurate, but it's just pretend. But in our case, we didn't take the 34% loss. The value of that, of the ability to sleep better at night, because it turned out to be 34%. It could have been 64%. I mean, you have no way of knowing, right? And to make the comeback, basically from a 34% deficit back up to a 15% positive or 10% positive, is much less likely, and it takes much more volatility and all that than it does to go from basically 0 up to the 10%. So it's doing this instead of doing this to get to the same place. That's what risk-adjusted return is.
And your bucket of money didn't shrink. And one of the things that we're working on with the performance thing is to give you guys basically a graphical representation of what it looks like when you don't have that volatility.
Yep.
Like we've talked about it in previous shows where you just have to do the math. All right. If you start with $100 and this person starts with $100 and they lose 34%, and then they got to wait to get back to their dollar.
Yep.
It's a math problem.
It is.
Right. And it works in your favor if you just got out. And it's easy to say, oh, I only took that on paper. Yeah, but you got to wait till you get back to here till you're back to even.
Yeah.
Where we got out, we might not have caught it at the bottom, but we are here and we have more money. The bottom line is my bucket is bigger than your bucket if you stayed in.
Yeah. I mean, I know there are people, I mean, when the show comes out, and it's going to be funny to watch the comments for a lot of reasons, I think, because they're going to be like, when are you guys going to stop talking and get to what you're supposed to be talking about? I haven't seen a single chart yet.
This is a podcast. We're supposed to be talking.
We have taken losses on and off over the last couple of months. And there's a lot of griping in the Facebook group about I'm down on the year. I'm down on the year too. And I have absolutely no problem with that.
Right.
I think I commented at one point, kind of snippety in there, about, hey, do you guys even read the alert? Like, do you guys have any idea what we're actually doing here? I'm down. It's been 6 weeks and I'm down. I'm like, it's a marathon. It's not a sprint.
Yeah.
The relativity, if you don't understand, and then we're gonna get into all this.
If you're in a 6 week game versus a 6 year, or no,
it's TSP. You get 2 moves a month.
Yeah.
We're going to get into all that.
It's not
we
day
have to keep
trading.
moving. All right. We got to keep going.
Keep going.
Seriously. All right.
I'm going to shut up for a while, guys.
Thank you. All right. Go get a drink or something. Okay. We said, I can barely remember, so let me go back to what we said we were going to do. Contribution, allocation, and interfund transfer rules. So if you guys remember, there was a lot of consternation about the alert on Tuesday because it was the third alert for the month, right? It was a big deal. I don't think we've done it ever, maybe. It wasn't a problem for me because I understand the rules, and I'm going to explain to you guys what the rules are. And I saw all kinds of people asking questions, and then when I would respond to those questions, it became clear why they weren't able to make the third move for the month, or why the way they made that move, TSP wouldn't let you do it. So here's what the page looks like. Okay, this is a screenshot of the Change Your Investments tab. Okay, so if you go to tsp.gov, Change Your Investments tab, this is what you get. It hits on 2 of the most important features that TSP that sort of affects our TSP that people don't really understand. All right, you got contribution allocations versus interfund transfer. Okay, so what are the rules for using each of them, and what's the differences between the two? Okay, contribution allocation. Contribution allocation is when you request a contribution allocation, you are telling TSP where to put the new money. Okay, the money that comes in every payday going forward. where do you want that money to be allocated? Into which funds do you want that money to go? Okay. It's the money that you're going to put into TSP going forward every payday. All right. That's your first bucket in TSP. There are no rules that apply to that. You can change your contribution allocations every day. I don't know what the dates are that the TSP decides to actually, withdraw from your paycheck and put it into TSP. I have no idea. But there are no rules for contribution allocation. Okay, it's the IFT that everybody gets wound up about. All right. So when you're an interfund transfer, okay, when you request an interfund transfer, you're telling TSP how to redistribute the money that you already have in your account. Okay, so the two buckets are the new money coming in, which is contribution allocation, and the money that you already have in your account, which is an interfund transfer. On the interfund transfer, that's where we get the two move a month rule. Okay, you get 2 interfund transfer requests per calendar month. Those 2 interfund transfers can be back and forth between any of the C, S, I, F, and G, and the L funds. They're all individual funds. Okay? There's nothing special about any of them. You can't say, well, I only moved to the G fund, so that doesn't count. No. Every single move you do counts. Okay? For the first 2. Any move after the second one can only increase your holdings in the G fund. So what does that mean? If you're well, I'm going to get to the examples in a minute, but any move that you do after the 2 moves can only increase your holdings in the G fund. Okay, that's all there is to it. But those are the limits. All right. So this is where everybody gets confused, and so I'm going to do an example of what we did earlier in the week. So we started last week. We were 50C, 50S, right? That's how we came into this week that we're in. This is an endless week. I can barely remember like where we were last week and doing this alert. It's unbelievable. I've been putting together the slide deck for a few days, and I'm having a hard time like keeping the pieces together. We came into the 3rd alert of the month in 50C, 50S, right? What we did on the alert was we went 50C, 50G. So all we did was move what we had in the S fund into the G fund. If we tried to go to 25C, 25F, 50G, can you do that? No. You know why you can't do that? Because you can only put money into the G fund. You can't go from the CNS to the F and the G. You can only go to the G fund. Okay? You can't reshuffle the deck. You can only increase into the G fund, which means you're going to have to decrease from one of the other funds, right? I don't know how else to say it. You can only move to the G fund. And fortunately, well, it's only Friday, and the market seems to be stabilizing, which we're going to get to, but we haven't had a subsequent alert, right? So the one that we did on Tuesday was the 3rd for the month. It's the 26th, 27th. This thing's going to come out on the 28th. There are still a couple days, trading days left in the month. It's unlikely, but it's not impossible that we could do another alert, a 4th one for the month. How can that be? Because we are 50C, 50G right now. And if I want to go to 49C, 51G, I can do it.
Right. You can move what you have left in increments
every day
of anything to G.
Yep.
Yeah.
Every day if I want.
Yeah.
I can move a little bit every day if I want.
And just so people understand like the strategic piece of that, all you're really doing, if you do that, is if your risk tolerance is at a certain point, you're like, it's feeling more risky, all you're doing is taking a little bit more off the table.
Yep.
That's all you're doing.
That's all you're doing.
That's all you're doing. You can call that loss if you want to. Okay? This is not stock speculation.
No.
It's not the same. Doesn't work like that. We don't get to move in and out.
Yeah.
What we're doing is slowly moving away from risk.
You're managing risk. That's right.
That's it.
Right.
And once you wrap your head around that and stop thinking like you're on Robin Hood.
Yeah. Yeah.
You finally get it.
Yeah. I mean, a good example, right? Say we're 10%. So you get the 50-day moving average, you get the 10-day moving average, and you get the price, right? Say the price is 10% above the 10-day moving average. It starts rolling over. You're like, oh, I don't like the way this looks. You take 25% out of the C fund, right? So say you're 100% in the C fund. You take 25% out because you don't like the way it looks. It comes down to the 10-day moving average, right? And now you're like, okay. The next day, it opened below the 10-day. Now you take another 25% off the table because the odds are it goes down to the 50-day, right? And that's how you're managing your risk coming down. That's a way to manage your risk coming down. You don't have to, as soon as the market rolls over, you don't have to go immediately all of it to G. You can segment your way down, and you can segment your way back up. It just, well, actually you can't. I take that back. You can't because you only get the two moves.
Right.
You only get the two
and
moves
that's the problem. Like if we were doing this with regular stock market, it's a whole different game.
Yeah, it's
a whole different game. You at that point, just so people understand the differences, and I so I get into this game right where if I'm making my moves on those same kind of decision points. Yeah, I get commission free and all. People understand somewhere along the way it's getting charged somewhere. You're not always getting no commissions, no fees, right? But let's just accept that and say that okay, at a certain point, like, am I making the moves, and then once all the fees that are involved, am I still making any money, right? So there is always going to be a limit to how in and out I can be. Let's just accept that. And so you're always going to, want to minimize that. And so the extreme version of that is what we have to do in the TSP.
Yeah.
You cannot treat this like day trading.
No.
You can't even treat it like week trading. It's not the same.
No. I mean, I've spent a lot of time over the last couple of years trying to figure out if there are better ways to look at it rather than the daily charts and the 10-day and the 50-day moving average. Because like you said, it's almost better to trade it weekly and look at monthly and weekly charts rather than 6-month daily charts. But I think it doesn't always work, obviously, in this environment we're in right now. It's an example of how it doesn't really work well. But in the longer scheme, if you use weekly charts, the range in a week can be a 10% range is not an unusual week.
Right.
And that's not something I'm willing to tolerate.
Right. Yeah, and the reason why we look at daily is more for pattern and historical recognition.
Yeah.
Right?
Well, the patterns are going to be the same no matter what.
Yeah.
It's just that you got to be willing to take. I mean, the patterns are the patterns, and of all, that's my thing. I do the patterns, right? But each one of those ticks represents a percentage of your account, and it's significant, right? So if it's a daily pattern, the percent can only really sort of be so much. If it's weekly, then the percent can be huge. And we're actually going to get into that.
Let's do it.
All right. So hopefully that took away some of the confusion about interfund transfers and change of fund allocations. Okay. This is going to be Elliott Wave 201. So here's what we're trying to accomplish out of this. The idea is to understand where we are in the big scheme of things, okay? So the Elliott Wave pattern, it gives us a structure to understand the idea of market risk, okay? So when we say market risk is extremely high, in terms of Elliott Wave, it means that we're approaching the end of an impulse wave, either 1, 3, or 5, right? Those are the impulse waves, and we're going to show that. If market risk is extremely high, It doesn't matter how old you are, how long you have to retire. It applies evenly to everybody, right? How you respond to it, on the other hand, can be very different depending on your personal risk tolerance and circumstances. All right, so what we're going to look at is the long-term super cycle. And then within that is the cycle. And then we're going to show the top of the top, basically, where we are right now. So if you remember last week on Elliott Wave 101, right? This is the ideal, right? It almost never looks like this in real life, but it can come pretty close, and we're going to see it here going forward. Elliott Wave it basically observes human fear and greed, and that's why it's consistently repeatable. Okay, it works best on broad indexes as opposed to individual stocks, but you can definitely apply it to pretty much any market. Bitcoin, Tesla, the NASDAQ in 2000, whatever. So one of the things I noticed that I didn't talk about last week, because we put the same chart up last week, because you could say, how do I know? How do I know when we talked about how the 3-leg right here, right? This is the 1, right? This is the 2. The 3-leg tends to extend. So if the 3-leg is extending, how do I know when the 4 is and the 5? Like, how do I know really where I am? And I didn't really talk about that. So what's the important distinction here? You got five legs up for the 1, and then you get 2 legs down for the 2, right? Then you get 5 legs up for the 3, 2 legs down for the 4, 5 legs up for the 5. And then what happens? Instead of the 1, 2, 3 legs down like we had here, right? ABC, right? We get ABC here, but what happens? It doesn't go higher. It comes up a little bit and then goes lower. So now instead of a 1, 2, 3, we got a 1, 2, 3 that keeps going. 4, 5. That's when you know the pattern has changed. Okay, so let's just do that real quick one more time. Here we got 1, we call it ABC because we know that after the fact. But what if it went 1, 2, 3, 4, 5? Since we know that the 5 waves are impulse waves, that's how we know the trend has changed. Okay? And the other way is trend lines. So the trend line analysis, when we connect the bottoms, you get the 1, 2, 3, right? We're over here, it was an ABC, right? ABC comes down to the trend line. This ABC, but then it continues past the trend line. And it comes back up and hits resistance at it and rolls over. Okay? So this is sort of a combination of Elliott Wave and trend line analysis. This is why I'm always looking at the trend lines and the moving average lines, and I'm saying, okay, we got below the 10-day, we came back up and we hit it, and it hit resistance, and then it came back down. So there's probably a trend change here relative to this one, right? Hopefully that makes sense, because it's a really important part of this whole thing. So that's how you know. This was ABC. This is 1, 2, 3, 4, 5. Okay, that's how you know the trend changed. Then once you know that, now you know you got an impulse move down, then you're going to have ABC higher. Then you have another impulse move down for a full ABC correction of the longer term. Okay? So 1, ABC, 2, right? They're patterns within patterns. Okay? Hopefully I just didn't go over everybody's head, but that's how the thing works. So how do we apply that, and why does it matter? This is not a chart that you're going to use to make trading decisions, okay? But it's pretty important to understand the basis of where we are. Here's the top in 1929. And here's the bottom in 1932 at the bottom of the Great Depression. Okay? This, you could go back to 16, I think it was a tulip whatever. There was a big, almost like a NASDAQ bubble. I don't know if I'm going to say if you remember, but I tried to find a place in Amsterdam one time that talked about that, and I never spent enough time there to figure it out. But there's a thing called the tulip bubble in the mid 1600s, and there was a shortage of tulip bulbs and a big demand and whatever, and it jacked up the prices of tulip bulbs just like the NASDAQ did in 2000, right? And then it was up there for a while. It went higher and higher, and everybody's speculating. And because the price went higher, people kept speculating. It was like the GameStop of 1650, So it pretty much was, or the PetSmart, Pet.com, and all the other crap on the .com bubble in 2000, right? So same thing happened in 1928, 29, and so we get to the top in 29. We have a big crash. If you were able to go back, which I can't do on this chart, if you were able to go back in history, okay, this is actually the top of a 3-leg on a super mega cycle. This is the top of a 3-leg, and this is the bottom of a 4-leg on the top of a multi-centennial cycle. Okay. So what does that mean? It means that from the bottom of the Great Depression to somewhere forward of where we are now, if this is a 3 that started back here in 16 whatever, and this is a 4, then this whole thing that we're in now, since the bottom of the Great Depression, is one gigantic 5-leg. Okay? So what happens, I don't even know if I want to say this, but I'm going to say it anyway. This is theoretical. Okay, this is theoretical, and it probably doesn't really affect us. Let's hope. It'll affect our grandkids, great-grandkids. Patterns within patterns, right? When you get to the top of the 5, you get an A, B, C correction. And the correction comes back to the prior 4-leg. Theoretically. Okay? What does that mean on this chart? We just said this is the 3, this is the 4. Theoretically, when we get to the 5 here, we get an A, B, C. Now, it doesn't mean that the numbers are going to be the same. It's on a percentage basis. So it's not going to look like this. It's on a percentage basis, right? This move right here was a 55% loss of your money. This move right here was a 50% loss. So you're not going to see a chart that looks like this. But on a percentage basis, if you lost, 80% of the value of the Dow Jones Industrial right now, it might take you down to like here. Which would correct this entire move. And it's not. It's absolutely possible, right? Absolutely possible. But that would correct the super mega. That's not even the super cycle. That's the more than the super cycle. So this is the super cycle. So we're starting here at the bottom in 1932, right? We got 1, 2, 3, ABC, 4, and 5, and we are approaching the top of this 5. Okay, so we're approaching the top of the super cycle 5, which started here and went 1, 2, 3, 4, 5. Right? We're also approaching the top of, because this was 3, this was 4, and this is going to be that 5. So you have this 5, you have this 5, and you also have 1, 2, 3, 4, 5. So you have 5 on 5 on 5. Right? We are approaching a top of a top of a top. It's very spooky if you live in my brain. I'm just telling you. So that's why when people say like market risk, right? If you look at this chart and you see it and you can draw it, 1, ABC is 2. If you were able to get in right here, you were killing it. And why would you know that you should have gotten in there? Well, because this is a 78% drop right here. So once you got a move up, a correction, it took out 50% of this move up, and then it went higher. Your odds of the market rolling over there are like zero, and it went higher forever, right? And it works on every time frame. So the only thing that so I say that to say we are approaching the top of a really important, to say it's a generational top is an understatement. All right. So what matters to us? This 4 is 2009. Okay. And it's going to, wave 5 is progressing out in 5 waves. Okay. So here we are at wave 4 in 2009. Okay. And what have we done so far? We've done 1, 2. Wave 3 is progressing out in 5 waves. 1, 2, 3, 4, 5 for wave 3. Then we had the coronavirus correction is wave 4. And now we're in wave 5. Okay. We're not at the top yet. I don't think we're at the top yet. I don't know for sure, but I don't think we're at the top yet. We could be, because the rules don't require a fifth of 5 waves within this. There's no reason, no technical Elliott Wave reason why the market can't just roll over right there. But the guidelines are that it's going to play out in 5 waves, and it sort of looks like we're going to get that 1, 2, 3, 4, 5, something like that, right? But we are much closer to the end than we are to the beginning, and so that's since 2009. Here we are. This is the 4 at the bottom of the coronavirus correction, right? Where am I? Right here. This is the bottom of the coronavirus correction. This is where we are right there. Okay? So since then, it hasn't played out in a really identifiable way. You could kind of say that this is a 1, ABC is 2, and we're in a 3. I mean, that's kind of how it looks. I just don't really like it. I don't like this as a 1. It doesn't really fit the rules, right? We said there are very few rules. You could make an argument for a 1, 2, 3, 4, 5, ABC for 2, right? You could say 1, 2. That would make this the 3, but the 3 can't be the shortest impulse wave. So if this is the 3, and then you get ABC 4, and then we're in 5 right here, the 3 leg is shorter than both the 1 and the 5, right? So we've broken 2 rules, and so we're saying that's not the pattern, right? So if you can't identify a pattern, then it just keeps going, and then this eventually is going to be the 1. Right? And it doesn't really matter. I mean, the counts matter, but they don't really matter, because at some point it's going to roll over and go A, B, C, and that's going to be the 2. So at any rate, the point of this was to give some perspective, the really, really long term, and how the patterns within patterns work, and where we are now. Was that too fast and too much, just like puking Elliott Wave all over the universe? I mean,
no, I think if you watched last week and you watched this week, it makes sense. Okay. If you didn't catch last week, you probably want to go back and check it out. But yeah, it makes sense when you put the 2 together. Yes.
Yeah. Okay. Good. All right. I feel like I need a break.
There's no break in podcasting.
Podcast. All right. No. Okay.
Next slide.
We're getting almost to the end. The Tsp Fun Charts. There were some comments on Facebook. People didn't know what the ticker symbols were, and so here they are. CFund is $SPX, SFund $DWCPF, iFund is the Europe Asia Far East Index EFA, and the FFund is the Aggregate Bond Index AGG.
And if you can't find the DWCPF for the SFund, which happens occasionally, like if you go to our site, what you actually see there is the VXF, Victor X-Ray Foxtrot. The reason for that is that the DW CPF, it's a licensing thing with the people that do the charts, right? So they're not always able to get that live. So if you don't find that, don't stress. No. Type in VXF.
VXF is
close enough.
It's the ETF that tracks the DW CPF. Yeah, definitely close enough. Okay. Here's the C fund for the last 6 months. Like we said, we did the alert on Tuesday. We were already 50% in the C fund, and we stayed there. Had a lot of comments on Facebook. Why are we still in the C fund? And I talked about it in the alert, but we let's see. Do this first. 1, 2, 3, 4, 5. So this day right here, this up day, was Friday last week. That update was Friday last week. Monday, Tuesday, Wednesday, the market rolled over this week. But on Thursday, we reversed at the 50-day moving average line, right? And then we went higher on Friday. Big time higher on Friday, up 1.66%. So we're not at a new all-time high yet, but we absolutely found really good support at the 50-day moving average, and then we jumped higher on Friday. So volume was okay on Friday, right? Not huge, but it was okay, and the indicators turned positive. So I'm comfortable with where we are. And if you read the alert last week, the big reason not to get out of the C fund for me was you got this low here. This low is actually higher than this one. This low is higher than that one. And then you got this high. This one's higher. This one's higher. So the trend is definitely still up. Okay, so the C fund is still in good shape. S fund is a completely different thing. Okay, and some of I've had a handful of people asking me about head and shoulders patterns in the S fund, and depending on what charting software you look at, it looks a little bit different, but this is how I'm looking at it. This is the S fund 6 months daily, right? You got the left shoulder, the head, the right shoulder, and this is the neckline. Okay, so according to the rules, you got the price of the head here, let's say it's $22.50, and you get the neckline here at $20.50, so 200 points. If we break below the neckline, the minimum we come down is 200 points from $20.50, which is what, $18.50. So the minimum we come down to is here. That's the theoretical minimum. We didn't break the neckline. So we were watching it. We came right to it on Wednesday. But then on Thursday, intraday, it broke below it, right? But the market reversed. It closed higher. And then on Friday, we had a little bit of a higher move. I'm not really optimistic about this. It would be absolutely possible that it just dribbles over and we get a close below the neckline, and then we're in trouble. It's absolutely possible. There's a lot of examples of stocks that have already done it. If you take a look at SAIC stock, it gapped down 15% today on the open, and it's got a head and shoulders pattern that looks exactly like this, except it's leading, so it's a couple days earlier than this. But you had a close here, and then today opened like down here. It's actually, let me take that back. This is what the SAIC pattern looks like. You had a breakdown. It came down, came back up, and hit just above the neckline. Came back down a little bit, and then gapped down like that. It's quite an amazing chart. I should have put it up. Maybe I'll do it on Facebook later. But that's where we are in the S fund. So one of two things in terms of your risk tolerance can happen here. On the one hand, we hit this support line, we hit this support line, we hit this support line, and every time we hit it, the market went higher. So you could make an argument for I'm going to get back into the S fund here because it hit support and it went higher. I'm going to get back in. Absolutely, you can do that. If you do it and it rolls over, it doesn't matter. The point is the trend is the neckline. If you get a close down here on the neckline, expect it to go lower. That's all I'm saying. All right. I'm not in the S fund, obviously. That's why I get out of it. I fund. I really like the I fund. It's not as volatile, right? It's been basically moving more or less sideways in this channel for a while. Had a great day on Friday, up on big volume. We've been showing the ratios between the I fund and the C fund for a while. We'll come back to that probably next week. It hasn't turned the corner yet. Like I'm not 100%. Obviously, I'm not in the I fund at all, so that should tell you something. The chart hasn't shown me that I should be in it yet, but I'm watching it really, really close. Okay. F fund. Last week or two, it was March 19th. Is that 2 weeks ago? March 19th? Why did we talk about the F fund?
Are you asking me?
Yeah,
2 weeks ago? I feel like it was 3 months ago. So
the 19th. No, that was last week. 19th is last week. Okay. Yeah. All right. So this is an example of Elliott Wave. So 1 ABC for 2, and we said 1, 2, 3, 4, 5 for 3, right? And then we said this little bit was going to be 4. And then a move down here, and were we at the 5? Okay, so that's why we're saying 5 question mark, because that's all the information that we had at the time. And we get the technical indicators moving higher, which supported the idea that we're at a bottom. Okay. Again, like we had referred to earlier, people were saying, well, if you thought that this was the bottom, why didn't you tell us to get back in and all that? And we explained why. But this is back on March 19th, March 19th, last week. And so here we are now. So here, let me see if I can get this exactly. Yeah, it is. Wow, it's exact. This day right here is the bottom. That's the exact bottom that we were at. Okay? And the market went higher from there. So yeah, we identified an exact bottom in the I fund. And so had we had the moves to get back into it available, we would have. Maybe not 100% certainly, but we would have, right? But we, because of the TSP rules, we didn't have it.
Yeah. And that's, I think, freaked a lot of people out because they were like, they saw our analysis of it.
Yep.
Saw us discussing it, and then all of a sudden we didn't get in it.
Yes.
Well, that's because we didn't have a move.
Because we didn't have a move. And I'll take the hit for it. But I'll take the hit for it. But again, I cannot put myself in everybody's shoes. Right. And that's not what I'm saying I'm doing. Right.
If you had a move and you watch our show every week,
yeah,
that might have been the ding, 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 ding. Like,
sure.
That's the double foot stomp, right? We're like,
sure.
Hey, you might want to, but we're not going to tell you to move into the F fund. That's not going to happen.
No, because we don't tell you what to do with your money. Exactly. We're telling you what we did with our money.
Yeah. And if you, we can beat that to death.
Yeah.
No. The bottom line is we gave you the information.
Yes. We did. Yeah. But let's not beat it to death. So, okay. Am I back on that chart?
You are now.
All right. So now after a new week, right? So we said that this was probably a 5. Now that another week has passed, I'm going to relook at this because I did not like this. I think I said it in the show. That as a 4 was too short of a time period for me because you get the ABC for a 2, right? 2 and 4 are supposed to be relatively symmetric. That's not what we got. So in the back of my mind, I'm like, I don't think this is a 5. I think it's probably a 3, but we'll see how it plays out. It didn't really matter because if it's a 3, the move from the 3 to a 4 is still a move up, so you could still get back in. It's just that you need to know that it's not the bottom, it's a bottom, right?
That's the confirmation of the analysis.
Yeah.
We have to wait.
Yeah, you do. Yeah, you have to wait.
So
that's where I'm getting to sort of right now at the end of this thing, you know, if this is the 4, because on Thursday, because we ran up this week. On Thursday we had a down day, and then on Friday we had a down day that tested the 10-day moving average. It stayed above it, but it was not a very strong day, right? So one of two things are going to happen. Next week, the I fund is going to continue low, or F fund is going to continue lower, and then this will be a 4, confirmed, and we'll get a 5. We'll be down here somewhere. Okay, then we'll have 1, 2, 3, 4, 5. That's one possibility. The other possibility is this actually was a 5 and not a 3, and it'll be 1, 2, 3, 4, 5, and this would be 1, and we'll get support there at the 10-day moving average, and it'll move higher, right? And now what we're looking at is the possibility that 1, 2, 3, is that an ABC or a 1, 2, 3, right? Is it ABC and really this is the 4 and then it comes down? Or is it 1, 2, 3, 4, 5, and then the new impulse wave is going higher? I don't know. We will see. But those are the things that
I kind of like that
occupy
last
my little
option.
brain.
I like the last option.
Well,
But just because I like it doesn't mean that's what's going to happen.
I like the last option too, bro. But I mean that if the F fund goes higher like that, it means interest rates go back down, and I just don't see it happening.
Yeah, I don't either.
So
Yep. And it's good to know all the pieces, right?
yeah,
It's not just the Elliott Wave pattern. Now we know that, like, is there a probability that interest rates are going to go down? I don't think so.
Yeah.
I don't think so.
All right, bro. I'm going to put you on the spot here.
Oh,
Remember AMRN?
I do.
I actually did go back this time and take a look.
Did you look and see
the
where they're from?
pharmaceuticals and all the rest of it. Yeah.
Yeah, they're in omega-3s.
Yeah. Out of Ireland too, Dublin.
Do you take your omega-3s?
No.
You don't anymore? I still do it. I don't feel any different, but I still take them.
I can't pay for things that don't make me feel different. It drives me crazy. I can't. I don't get me on the supplement thing.
No.
I can't do it. All right. AMRN. This was the chart last week. You bought it. I didn't buy it.
Yeah.
So we were right on the 10-day moving or the 50-day moving average right there, and it had reversed a little bit higher. And my question was, do you buy it there or not? And there was no right or wrong answer, but
Yeah.
you know, and you said, "Yep, my risk tolerance is higher than yours," or whatever. You would buy it.
What happened?
I did not buy it. You want to know what happened?
Yeah, I want to see what happened.
Okay, so this is where we were, right there at the 10-day moving average line.
Yeah.
So the market broke lower. That's fine. What I didn't see this week, I didn't see it last week when we were talking about it,
Mm-hmm.
but I saw it very clearly as I was putting these charts together for the show. You got a support point here. This is when I bought it originally on the breakout.
Yeah.
You got a support point there. You got a support point there. So when should we buy it? Thursday.
Yeah.
Right?
Why didn't you put that line in there last week?
I didn't see it. Why didn't you put the line in there, bro? Yeah, right?
I do this part.
I know. I mean, you can see that though, right? The symmetry is.
Yeah. No, it's clear.
It's clear as can be.
Yeah.
Right.
And I think if you'd have been focusing on that one stock more than anything else, you probably would have caught that.
Right.
But
this started as what we call it, the bonus chart or whatever we call it. Right.
Yeah. And I think I don't think you mentioned that earlier, but that's something that we're looking at doing just for fun. Honestly, it's not going to be anything else. But it's kind of picking a chart of the week, maybe a chart of the month kind of thing to say, hey guys, take a look at this. And it's not going to be us telling you to buy it, but it's going to be like, it's a technical analysis kind of example.
Yep.
And if you see something you like, well, great. Maybe you take advantage of it.
Yep.
You know?
Yep. No, I like that.
Buy some Blue Star. It's always a Wall Street.
Blue Horseshoe loves Blue Star. Was it not Blue Horseshoe? Something Horseshoe loves Anacott Steel. Blue Horseshoe loves Anacott Steel. That's what it was.
That's it.
I could go back and watch that movie again. Yeah, but so just while we're looking at this, you got this RSI, this on the low, right? On this low, the RSI is here. On this low, the RSI is higher. What that means is there was not as much selling pressure to get the price down to the same level. So I'm gonna look on Monday, but I'm gonna go out on a limb and say I'm gonna buy that on Monday. We'll see what happens. But if I did buy it, since we're not talking about TSP, right now it's 606. If I was able to buy it at 606, I would have to be willing to hold it until somewhere below 550. Because if it rolled over, and because our whole thesis is this 550 line is the support, right? So if I bought it here at 606, I'd have to be willing to hold it to 550 before I sold it. If it closed below 550, I'd sell it. That's a huge move lower on a percentage basis.
Right. Because you got to let it see what it's going to do.
Yeah,
you have to let it play out.
The pattern requires you to let it play out from 606 to 550, which is on a percentage basis is a lot of money. So they're two different things. That's why you know some people do penny stocks, some people do whatever. It's if you're not comfortable with the percentage moves of your account. I never ever, literally ever, look at the account at the dollar value of my account.
It's percentages.
I only look at the chart.
Yeah.
Because I wouldn't be able to function if I looked at how much did I lose today. I lost $5,000 today. Like I could have bought, whatever. I can't. Yeah. I can't function that way.
I don't understand. I mean, I know people do. I get it.
Yeah,
I get it. But if that's your come from, you shouldn't be in this.
No, I should be in L funds.
Honestly, that's probably the most honest answer. Like you could give is to tell people if you can't handle just looking at the market and looking at the charts and looking at the percentages and just playing that game, get out and just put it in the L fund and hope for the best.
Yeah.
Honestly. And
you know what? Put it in the L fund and trying to get promoted and put more money into your TSP. Right. Just keep dumping more into it.
Try to get promoted.
Keep climbing the ladder. Because that's the three things, right? Time in the market, how much you contribute, and what your rate of return is. The only three things that affect how much your golden egg is at the end.
Right. And the key thing with the L fund is that you don't have to think about it. Yep. But you could beat that. You could beat the L fund. We've proven we can beat it.
We can do it. It's just that if it's not your game, then don't play it.
Then get out of it. Yeah, that's true. Yeah. That's true.
Bro, I'm done.
Questions? I don't have no questions.
Good. This is the longest show ever.
Well, we are at 1 hour, 27 minutes.
Oh my God, that's not that bad. It's only 27 minutes more than
you thought it was. Yeah,
but
it is.
I thought you were gonna say like 4 hours and 85 minutes.
I think it's the longest show we've done. I'd have to go back and look. There's a couple in the early days where we kind of rambled on, but yeah. I mean, here's the thing though, and I posted it on Facebook just now. I took a little picture and I said,
I was wondering what you were doing over there.
I was social media. I truly believe between last show and this show, like if you made it this far and you didn't get
you're still listening.
Yeah, if you didn't get something out of that, man, I mean, you're missing it. You're not listening. Yeah. Because we just gave just so much information about how you can make this work. And like anything, right? I was talking about somebody with this before we came on the podcast. I was having a beer with a buddy, and I was like, if people just have to be willing to give something. If you want to learn Spanish, how long are you going to give it?
As long as it takes.
Right. Let's say a year.
Okay, sure.
Right? Something. You're going to have to put the time in. Yeah. Right?
Sure.
If you're going to learn something. So, okay, give this 3 months. Give this 6 months. Is that time frame worth what you're going to get for the rest of your life?
Well, see what I think the predominant thought is I'll give it 3 months, meaning let me see how these guys do for 3 months.
Yeah.
That's not
what we're talking about.
Let's give it 3 months that I will spend that time learning technical analysis and see if my way of TSP allocation decisions, works with that, and I want to go forward. It's not. Let me see how much money these guys make me in 3 months.
Yeah, how much can you learn in 6 months to start doing this on your own?
Yeah,
that's our game. If your game is only to follow us for the next 20 years, well, here's one thing I'll say. Here's one thing I'll say. It'll work.
It'll work
because I did it right, and I know you're going to come out on the upside.
Yeah. You'll take some losses along the way.
You are. But the difference is learning this you can apply to other investment strategies.
Yeah.
And that's what, that I think that's the secret to the game that we've learned is we're not just playing the TSP game, right? We are playing it.
Yep. We're
going to continue playing it. We're in it. But at some point you leave the government and you go, or you don't leave the government. So we're talking about this all the time where, I can only put so much in the TSP.
Yep.
Right.
Yep.
But what if I set an extra $5,000 a year aside and put that in an IRA or just any
a
investment,
trading account, anything? Sure.
Why can't I play that game a little riskier, a little different, or you can
absolutely
you can, and you can use these same principles to do it.
Yep.
And it's been successful. And I wish to God somebody had set me down at 22 and done this. And that's why we're here. So hopefully you guys got something out of this show, guys and gals. We are 1 hour and 31 minutes in. I'm calling it quits.
Call it quits, bro. We got to go.
Because I got to go eat dinner.
Yeah. Have a good weekend.
Right. Hope you guys enjoyed. Here's the music.
Peace.
Cue Jerry's
like that
drum. There you go.